Imagine a scenario, once unthinkable, where the world suddenly stopped buying U.S. debt. What would that mean? For decades, U.S. Treasury bonds have been the bedrock of global finance, seen as the ultimate safe haven. But what if this foundation began to crack? What would be the profound economic and geopolitical consequences? Today, we delve into this critical question, exploring the intricate web of global finance and the early warning signs that could lead to a worldwide refusal to purchase U.S. debt. First, let's understand what U.S. national debt truly is. It's the money the U.S. government owes. This debt is primarily financed through the issuance of Treasury securities, bills, notes, and bonds. These are essentially loans to the government, promising a return to the investor. Why do foreign countries and institutions invest so heavily in these securities? The primary reason is their perceived safety and liquidity. They are considered virtually risk-free. The U.S. government has never defaulted on its debt, making it a reliable investment. Furthermore, the sheer size and depth of the U.S. Treasury market ensure high liquidity. Investors can buy or sell these bonds quickly without significantly impacting their price. This makes them ideal for central banks to hold as foreign exchange reserves. The U.S. dollar's status as the world's primary reserve currency also plays a crucial role. Many international transactions are conducted in dollars, and central banks need dollar assets. Holding U.S. Treasuries provides a stable store of value and facilitates global trade. Major foreign holders include nations like Japan, China, and the United Kingdom. These countries accumulate dollars through trade surpluses and invest them in U.S. debt. This symbiotic relationship has underpinned global economic stability for decades. It allows the U.S. to finance its spending at relatively low interest rates, while providing other nations with a secure place to park their excess capital. The perception of U.S. Treasury bonds as a safe haven asset is deeply ingrained. It's a belief built on decades of economic stability and political reliability. This trust is not just about financial returns, it's about global financial architecture. Any threat to this perception could have far-reaching implications for everyone. The system relies on continuous demand for these bonds from around the globe. A steady stream of buyers ensures the U.S. government can always fund its operations and roll over its existing debt without causing market panic or soaring interest rates. This global reliance on U.S. debt is a cornerstone of the current international order. It's a complex dance between economic necessity and geopolitical strategy, but what could disrupt this delicate balance? What could trigger a refusal? One major trigger is a significant loss of confidence in the U.S. economy or political stability. Economic trust can erode due to persistent high inflation, devaluing the dollar, or prolonged periods of recession, signaling a weakening economic powerhouse. Fiscal irresponsibility, such as unchecked spending leading to ballooning deficits, is another factor. If investors perceive the U.S. government is unable or unwilling to manage its finances responsibly, they might question the long-term value and safety of their investments. Political gridlock, especially around critical issues like the debt ceiling, also causes concern. Repeated brinkmanship over defaulting on debt can severely damage investor confidence. A credit rating downgrade, as seen in the past, can send shockwaves through markets. It signals to the world that even the safest asset might carry unforeseen risks beyond economics. Political stability is paramount. Global leadership questions can sow doubt, polarization within the U.S., affecting governance and policy consistency, is a concern. Geopolitical shifts represent another powerful category of triggers. Major international conflicts, especially those involving the U.S., can destabilize markets and impact global trade, making dollar assets less attractive. Changing alliances, such as the rise of new economic blocs, could challenge the dollar's dominance. Efforts towards de-dollarization, where countries seek alternatives to the U.S. dollar for trade and reserves, could gradually diminish the need for U.S. Treasury bonds. The emergence of alternative reserve currencies or new financial systems also poses a threat. If other nations offer equally stable and liquid investment opportunities, the rise of digital currencies or new financial instruments could also reshape global finance. Sanctions, while intended to exert pressure, can have unintended consequences, pushing targeted nations to seek non-dollar alternatives and reduce their reliance on U.S. assets. So, what would happen if the world truly stopped buying US debt? The immediate impact on the US would be severe. Interest rates would skyrocket. The dollar's value would plummet, making imports expensive and fueling inflation. The government would struggle to fund its operations, potentially leading to drastic cuts. Globally, the ripple effects would be catastrophic, disrupting trade and financial systems. Geopolitical power would shift dramatically as nations seek new economic anchors. The scenario of the world refusing US debt is a stark reminder of global interdependence. It underscores the need for sound economic policies and stable international relations. Understanding these triggers is crucial for navigating the complexities of our financial future. Imagine a world where nations refuse to buy US debt. What would be the profound consequences? This hypothetical scenario, while extreme, highlights the intricate web of global finance and power dynamics. First, let's consider the global economic ripple effects. Financial markets would face unprecedented instability. Investors would flee risk, seeking safer havens, triggering a potential global financial crisis. This could accelerate de-dollarization efforts as nations seek alternatives to the US dollar. New financial blocks and alternative reserve currencies would emerge, reshaping the global monetary landscape. The geopolitical consequences would be equally profound. US influence would diminish significantly. A loss of economic leverage would weaken its position on the global stage, impacting diplomatic relations. Countries like China or the EU could gain more financial sway, leading to a rebalancing of power. This would result in a reordering of international relations and alliances, creating a less predictable world. Increased global instability would follow, driven by economic uncertainty and shifting allegiances. So, what potential responses could the US employ to mitigate such a crisis? Domestic austerity measures would likely be necessary, with drastic cuts to government programs and services. Monetary policy adjustments by the Federal Reserve would be crucial to stabilize markets. Diplomacy efforts would focus on rebuilding international trust and forging new economic partnerships. The U.S. would need to secure financial stability through renewed global cooperation. Innovation and economic restructuring would be key, focusing on domestic growth and technological advancement. Reducing external dependencies and fostering self-reliance would become paramount. In conclusion, while this scenario is hypothetical, it underscores the severity and complexity of such an event. It highlights the profound interconnectedness of the global economy, where actions in one area ripple worldwide. The future of global finance and the US dollar's role remains a dynamic and evolving discussion. Understanding these potential shifts is vital for navigating the complexities of our modern world. Imagine a world where the bedrock of global finance, the US dollar, faces an unprecedented challenge. What if, hypothetically, nations around the globe collectively decided to stop purchasing US debt? This isn't just an economic tremor, it's a potential earthquake. Today, we delve into the profound geopolitical consequences and the strategic responses the United States might employ in such an extraordinary scenario. Our discussion will explore the ripple effects across financial markets and the shifting sands of global power. First, let's consider the immediate economic fallout. A refusal to buy U.S. debt would trigger immense financial market instability worldwide. Investors would flee risk, seeking safer havens, but where would they go? This scenario could easily spiral into a global financial crisis. The very foundations of international trade and investment would be shaken, leading to widespread economic contraction and uncertainty. Simultaneously, this crisis would accelerate the ongoing de-dollarization efforts. Nations would scramble to reduce their reliance on the US dollar. We would witness the rapid emergence of new financial blocks and alternative reserve currencies, challenging the dollar's long-standing hegemony. This shift wouldn't be gradual, it would be a swift, decisive move by countries seeking stability outside the traditional dollar-centric system. Beyond economics, the geopolitical landscape would be irrevocably altered. The most immediate impact would be a significantly diminished U.S. influence. The economic leverage the U.S. wields through its debt market is immense. Losing this would strip away a powerful tool of foreign policy. This vacuum would not remain empty. Countries like China or the EU would likely gain more financial sway, leading to a profound reshaping of global power dynamics. the world order we know would be fundamentally challenged. This shift would result in a less predictable and more fragmented world. Alliances would be reordered, and international relations would become complex, ultimately. This scenario points to increased global instability, driven by economic uncertainty and rapidly shifting geopolitical alignments. So, how might the United States respond to such an existential threat to its financial and geopolitical standing? One immediate, albeit painful, response would be domestic austerity measures. Drastic cuts to government programs and services would be necessary to manage deficits and restore fiscal credibility. The nation would have to make difficult choices, impacting every citizen. Monetary policy adjustments by the Federal Reserve would also be critical. Interventions to stabilize markets and restore confidence would be paramount. These could include interest rate changes, quantitative easing, or other unconventional measures to inject liquidity and calm fears. Diplomatic efforts would be intensified to rebuild international trust and forge new economic partnerships. The U.S. would need to demonstrate its commitment to global financial stability and its willingness to adapt to a changing world. Finally, innovation and economic restructuring would be paramount, focusing on domestic growth and technological advancement, and fostering self-reliance to reduce external dependencies would be crucial for long-term resilience. In conclusion, while extreme, this hypothetical scenario highlights the profound interconnectedness of the global economy. The severity and complexity of such an event would test the limits of international cooperation and national resolve. It forces us to consider the future of global finance and the US dollar's enduring or evolving role. What are your thoughts on this scenario? Share your insights in the comments below. Don't forget to like this video and subscribe to our channel for more insightful content on global economics and politics.